Namaskar friends, welcome to the channel JIV and CIV Made Simple. Today we are going to discuss our unit number 25 of PPB. Chapter is regarding the personal finance. So let's get started. The first aspect of personal finance, which is nothing but the credit card. Want to buy now and pay later? There is a concept that is called BNPL. Right? BNPL means buy now and pay later. Without carrying cash, that is a credit card. Simple, powerful, easy to manage. Right? And easy to misuse if you're not careful. Let's break it down step by step. So first of all, credit card is a card a bank or card company give you that let you buy goods and services now. So using the credit card, you can buy goods, like two words are there, you can purchase goods and services now, right? And the card issuer promised the merchant it will pay and you repay the bank later. Okay, so basically what happened, that the card issuer, whoever has issued the card, they promise the merchant it will pay and you repay the bank later. So see how it works step by step. Let me show you the step by step working of this credit card. First of all, the bank, who are the parties involved? Let me explain every part of it. So the bank, right? Or you call it the bank or you call it the issuer. Okay, so bank and issuer approve you and give a card with a credit limit. This card has a credit limit. Okay, bank or issuer approve you and give a card with a credit limit. You as the card holder buy something. Okay, you buy something at a shop, right? Or you buy something online, which we call as merchant banking. Right, this is called merchant. You buy something at a shop or online, this is called merchant. And this merchant, you are the card holder. You buy something at the shop or online, that's called merchant. Now merchant send transaction to their bank. What merchant do? Merchant send transaction to their bank, and bank is called merchant acquirer. Bank is called merchant acquirer. So issuer give the credit card with credit limit. You buy at a shop at merchant. Merchant send this transaction detail to the bank, that is called merchant acquirer, and through the card network. Your bank check your available limit and authorize the purchase. Your bank check your limit and authorize the purchase, and transactions are settled between the banks later. This is another bank and this is another bank, right? The transactions are settled between the bank later. And basically, if authorized, the merchant complete the sale. The issuer guarantee payment to the merchant. This is the bank or issuer. He guarantee that merchant will get paid. Transactions are settled between the banks later, and you get a monthly bill. What you get? You get a monthly bill, which is the billing cycle. Pay the bill in full within the interest free period, usually 15 to 51 days to avoid interest. Right? So you pay the bill full within the interest period. You can also withdraw cash from ATM, which is a kind of cash advance, but that usually cost fee and immediate interest. Suppose you use the credit card to withdraw the amount from the cash from the ATM. So in that case, it will cost you fee, and there is usually an immediate interest. The same thing has been explained here. You can see here what are the parties involved, like card holder, the card issuer. Card issuer is the bank, merchant acquirer, credit card association. Okay, and you get an interest-free credit for 15 to 51 days. And next point, card withdrawal from ATM. It is possible, right? So these are the points. So card holder is the person who owns the card. Issuer is the bank or company that issues the card. Merchant is the shop or website where you buy. Merchant acquirer is the merchant bank that receives the sale. Card association and network means companies like Visa, MasterCard, RuPay that connect the bank. So what is the meaning of this term authorization? Do you know the meaning of authorization? Let me explain. Authorization means the yes or no check your bank does before a purchase complete. So your bank does yes or no check before completing a purchase. Then we have the billing cycle and payment statement. So the monthly period after which you get a bill. Interest free period, you know it very well, right? So let me illustrate it using one simple example. Take the case of Priya. Okay, what Priya does, So Priya buy a phone for 20,000 rupees. Okay, with her credit card. Her bank authorize it. The shop get paid. Priya receive a bill next month. If she pay the full amount within the interest free period, it's like a short free loan. If she pay only a part, interest kicks on the remaining amount. Right. Now let's talk about the advantage and disadvantage of this. What are the advantage and disadvantage of this, credit card? So advantage is that, the benefit is that convenience, no need to carry cash. Right. It's quite convenient. No need to carry cash. Short interest free period. You get short interest free credit. You get credit for a short period, and that too interest free. Reward and discounts are there. Insurance on some cards. Easy proof of purchase. So that is how the credit card benefit the customer, right? And how it benefit the merchant? Let's look at it. Higher sales, increase sale due to increased purchasing power of the cardholder, fewer cash handling points, and disadvantage is that risk of overspending for the customer, right? High interest. Suppose you carry a balance, then interest charge is very teaser rate interest it is, an expensive cash advance. Right, cash advance is also expensive, and then merchant pay processing fee, risk of fraud, etc., etc. So remember, credit card is now BNPL, buy now pay later. This is the system, right? Main parties are who are the main parties? Cardholder, issuer, merchant, merchant acquirer, card network. How the process work like? The process is very simple, step by step process. First of all, you authorize, authorization happen. After authorization, settlement happen. After settlement, monthly will get generated. This is the process. Interest free period we talked about. Cash advance will carry fee plus immediate interest. Benefit and disadvantage we have just talked now. Now let's look at the next slide. Advantage, disadvantage we have gone through. Right. Yes. Let's look at this slide. Card issuer must not report any credit information. Yes, very, very important. Yes, here you can see. So friends, confused about card activation, EMI or insurance on your credit card. Let's make the RBI rule simple. Basically we are going to study the rule that bank and card company must follow when they issue or manage the credit card. First of all, when a bank give you a new credit card, it must not send any credit report information about that card to the credit bureau until you activate it. Right. So until you activate, so you can see the credit card issuer must not report any credit information to the CIC prior to the activation of the card. Right. That protect you if you never use the card. If you or a merchant asks to turn a card purchase into EMI, so conversion of credit card transaction to EMI, right? If you or a merchant asks to turn card purchase into EMI, the card issuer must be fully transparent. Right, card issuer must ensure full transparency, showing the principal, showing the interest, any upfront discount, and any extra charge. No hidden math should be there. No hidden math. Now, any loan offered through the card, like suppose some cash loan is given, right? Suppose some cash loan is there or EMI loan is there. So any loan through the card, like cash loan or EMI loan, must follow RBI rule for loan and advance, meaning a standard loan route and a standard loan rule and check apply. Right, remember it. The standard rule and check both will apply. Is it clear? I hope it is. And then we have any loan offered through the card must follow the RBI rule for loan advance. Just now I told you. If the card come with insurance, yes. Suppose an insurance is offered with the card. If the insurance is offered with the card, right? If the card come with insurance, the issuer must get your explicit written or digital consent. Either explicit consent or digital consent. Issuer must get your explicit and digital consent and record nominee detail. You must opt in, not be opted in silently. Okay. Now there are different kinds of card you should know. There are some cards are called co-branded card. You know what is the meaning of co-branded card? So co-branded card means bank plus a store bank. Co-branded means sum of two. There is a bank and there is a store or there is a brand. Then we have the second kind of card we have is corporate credit card. Corporate credit card means what? For companies and employee. And finally add-on card. Add-on card means extra card for family members. So co-branded means what? Co-branded means bank plus a store or brand. Corporate credit, you know it very well, for companies. Add-on card means extra card for family member. You know, bank and NBFC must explain the important terms and conditions. Relevant terms and conditions must be explained, right? For what? When you apply, not bury them in the fine print. Now, you know, they must also tell you the targeted time to issue the card, so you know when to expect it. Targeted time for issuance. And the bank may issue deactivated credit card, right, which is not to use ready credit card when your profile fits. Okay, those cards only become active after you accept the card and complete the activation step. So here are some words which you must keep in the mind. The first is the CIC. You know what CIC? Credit Information Company. So you know these are the credit bureau that collect your loan and card history. Like the example CIBIL. You might have heard of the CIBIL, right? Then you know activate. Activate means the step you do to make the card usable. EMI conversion. EMI conversion means what? That turning a one-time purchase into monthly installment. Yes, this is a point. Converting the transaction into EMI. That is the point. Then principal and interest. Principal is the amount, interest is the cost of borrowing. Principal, you know, is an amount and interest is the cost of borrowing. Co-branded card we have just talked now. That is the card issued with a retail brand. Corporate card means used by employee but billed to the company. Add-on card is a secondary card for family tied to the main account. So let's take one example. Suppose Ritika take a card, right? Take a credit card. She took a credit card, okay. But you know, the bank mailed her the card, but it is deactivated. The card was deactivated. The bank cannot report that card to the credit bureau. CIC. The bank cannot report that card to the CIC, okay, to the credit bureau until she activated. If she convert a 30,000 rupees phone purchase to EMI, okay, the bank has to show the actual EMI interest and any discount before she agreed. So these are covered in the RBI Master Direction and related FAQ. The key ideas are no reporting before activation, full transparency for EMI conversion, written consent for insurance and clear disclosure of the terms. So do not report to CIC before activation. EMI conversion must follow the principal, interest and any discount. Loan via credit card must follow RBI loan rule. Insurance means explicit. Full disclosure, right? So this term is about full disclosure, which means that when a bank issue a credit card, it must tell you all the important terms and conditions, right? It must disclose the all important terms and conditions to the customer. This is called full disclosure. Next point is notice before change. Suppose the bank want to change your credit card term, right? So if there are any changes made to the credit card agreement, RBI requires the issuer to give you advance notice, right? So what RBI required? RBI required the issuer to give advance notice for the same. Okay, advance notice. Okay, so that you can decide what to do. So RBI Master Direction says 30-day notice, not 45 days. So you can see you must receive at least 45-day notice. In your book it is written 45-day notice. Then you have a wrong bill. So what happens when the wrong bill is there? So if there is a wrong bill, bank must respond. Okay, so bank must respond. So if you get a wrong bill, the issuing bank should not send incorrect bill repeatedly, right? So if there is a wrong bill, then in that case, issuing bank should not send incorrect bill repeatedly, right? Rather, they must investigate and explain the issue. And there is a time frame for reply. Then we have grievance redressal. You know what is the meaning of grievance redressal? It simply means that bank must have a complaint system with a designated officer, right, and automatic escalation path so that unresolved complaint move up quickly, right? And if the bank does not reply within the RBI time frame, you can go to ombudsman, right? For unresolved complaint, you can go to ombudsman. Then EMB, then we have something called EMB chip plus lost card blocking. So new card or EMB chip plus pin safer than mag strip. So whatever new card we have, it includes two things. It is EMB chip, right, plus pin means which is safer than mag stripe, right? And bank must block a lost or a stolen card immediately when you report it. They must also tell you how to report loss and how replacement work. Then we have alert for transaction. This is the point. So which means you should get immediate SMS or email or app notification for card transaction so that you can spot unauthorized use quickly. Then we have two-factor authentication, or we call it additional factor authentication. So online transaction for which is called card not present. CNP, card not present. These are called online transaction. So online transaction require extra verification like OTP or any other additional factor authentication. RBI has required AFA for many other online card uses and is tightening rule for cross-border CNP transaction also. In the next point we have tokenization. What is the meaning of this tokenization? Let's understand. So tokenization replaces your actual card number with a unique token for a merchant or device. The merchant never sees your real card detail. Token registration and use require your consent and certain authentication steps. So what we have discussed in this slide, we discussed about EMV chips and PIN, AFA and 2FA, which is extra check. Tokenization, which means merchant sees a token which is a safe code instead of your real card number. It is safer for recurring payment and card on file. And ombudsman is the RBI appointed complaint office you can approach if your bank does not fix your problem. So for example, let's take one example to understand all this thing. Suppose ASA gets a mail. Suppose ASA gets an email that we are changing your annual fee effective in 30 days. She reads the new terms, does not like it, call the bank to close the card. No extra closure fee allowed in such cases. Or she keep it after accepting the change. If the fraudulent charge appear and the bank does not reply in time, she can escalate it to RBI ombudsman. So remember, card issuer must disclose all the important terms. Change to the terms like RBI expect advance notice almost of 45 days. Wrong bill and dispute, bank must investigate, escalate to ombudsman if no reply in RBI timeline. Card must be EMB or EMV and PIN. Right, EMB card must be EMB chip as well as the PIN, which means that report and get lost card blocked immediately. Then get email, SMS, app alert for every transaction. Check them daily. Online or CNP payment needs two-factor or AFA, additional factor authentication. RBI is strengthening rule. And tokenization is safer. Real card detail are not shared with merchant. Require your consent. Now friends, before you get a credit card, do you know what bank check, what rule you must follow and what you are responsible for? Let's break it down. So first of all, issuance of credit card. So bank check your credit worthiness. Yes, bank must assess your credit worthiness before giving you a card. This is basically checking your ability to repay. Which means what is the meaning of credit worthiness? Whether you are ability. This is called ability to repay. Whether you are capable of repaying or not. You, the card holder, must agree to all the terms as well as the condition. Right? Nothing is automatic. So you must agree to all the terms and the condition of the card. Right? Nothing is automatic. And bank must protect your personal information and ensure that your data is secure. So bank must protect your personal information and ensure that your data is secure. And bank must have a system to detect misuse or fraud. To detect card misuse, to detect any fraud, bank must have a system and inform you immediately of any unauthorized transaction. These are the key points. Now let's talk about the credit card eligibility. So bank must tell you the eligibility criteria clearly when you get a card. Important factor includes your income. It also includes the credit history. Right. Higher income and good past repayment history increases the chance. If you look at the credit card uses, I told you that you must use the card according to the laws and regulation. Comply with regulation and law. Bank must ensure transparency in the fee, in the charges, in the interest rate. And add-on card cannot be issued to the minor. You cannot issue add-on card to the minor. And the card holder is responsible for all transaction on the card. Who is responsible? Whose responsibility it is? Card holder responsibility it is. Right. So there are some words you must keep in the mind. Credit worthiness, which means what? That your ability to repay money based on income, existing loan and credit history. Then terms and condition, which means rules you agree to follow while using the cards. Then we have data security, which means protecting your personal and financial information from leak and hack. Unauthorized transaction. Unauthorized transaction means that any payment made on your card that you did not approve. Then we have add-on. Add-on card means secondary card linked to the main card. For example, let's take one example. Suppose Rohan is a person, right? And this person Rohan, he applied for a credit card, right? He applied for a credit card. Now, the bank check his income and the past credit his data. He agreed to the card term and relieve it, right? He agreed to the card term and he relieve it. One day he noticed a payment he did not make. The bank alert him, investigate and block further unauthorized uses. So what are the keywords which we have seen here? The first word is the issuance. Issuance means checking the creditworthiness, cardholder consent, data security, fraud detection. Eligibility. Eligibility means that based on income and credit history. Uses. Uses means you should follow regulation, fees and interest must be transparent. Add-on card means not for minor. Responsibility means cardholder liable for all transaction. Friends, ever wondered how your credit card limit work? Why you got those monthly statement? So this part explains the credit card limit including add-on card, monthly statement. So banks set a credit limit, the maximum amount you can spend on your card. That's called the credit limit. Okay. So for add-on credit, the limit may be lower than the main card, right? That is called the add-on credit. And one more thing is that if the bank reduces your credit limit, they must inform you and give a reason for this reduction. Let's talk about the credit card statement. Bank must send monthly statement showing all your transaction including purchases, payment, interest as well as fee. They will show you all your transaction, right? A statement can be received via post, courier, email or accessed on internet banking. Keeping track of a statement help you monitor spending. Yes, if you keep track of the investment, you can monitor your spending, spot unauthorized transaction and plan repayment. So credit limit means the maximum spending allowed. Add-on card is the secondary card linked to the main card, often for family member. And monthly statement is the document which lists all the transaction and payment during the billing cycle. Like suppose Anil, take the case of Anil. Anil has a credit card with 1 lakh rupees limit. Right. Anil has a credit card with 1 lakh rupees limit. Now his wife add-on card has a 50,000 limit. 1 month the bank reduces his main card limit to 90,000. Okay. So in that case, and send an email explaining why it was reduced. Later he check his monthly statement online to verify all the purchases. So these are the points which we have just made it clear through this particular slide. So friends, remember, bank can set lower limit for add-on card. Bank must inform customer if the limit is reduced, right, and state the reason. A statement can be sent via post, courier, email or internet banking. A statement help track spending, detect fraud and plan payment accordingly. Friends, before reporting default, let's talk about the point is before reporting any default. Bank must follow a procedure before reporting default to CIC, right? So they must report to the CIC. CIC means Credit Information Company. They cannot report wrongly. Due process ensure that your credit record is protected. Then interest rate and other charges. Bank must charge justifiable interest rate. See the keywords. Remember, they must charge justifiable interest rate. Okay, and set a ceiling. They cannot randomly charge you. And transparency is required for free credit card. For free credit card, transparency is required, and variable and for variable interest rate. Next point is bank must clearly show how finance charge are calculated. So they must show the method of calculation of finance charge. Okay, how it is calculated, and they should provide examples. Now there is something called APR. What is the meaning of APR? It's called annualized percentage rates. So the APR must be quoted along with the calculation method and example. That APR must be quoted. And even if you pay only the minimum amount, interest is charged on the remaining due, right? Suppose you pay the minimum amount. Right? Interest is charged on the amount due, right? On the minimum. Even if you pay the minimum amount, interest is charged on the remaining due. Any change in the fee, any change in the charges or terms must be communicated with at least 1 month notice. This is a very, very important part. Right, what about the card cancellation? So remember, bank must promptly process any request to cancel the card. Right, comply with any request for cancellation of the card, and they must confirm the closure or cancellation to the card holder. Any outstanding amount must be paid in full before cancellation is completed. So we started with CICs. CIC stands for Credit Information Company. Here you can see written here, CICs. Right, Credit Information Company. So basically a bureau like civil. Example you could give like civil. A bureau like civil that keeps track of loan and card repayment. Default. Then we talk about the default. What is the meaning of default? Default means not paying your credit card bill on time. That is called defaulting. Then we have the finance charge. So what is the meaning of finance charge? It means interest and fee charged on the borrowed amount. It's called finance charge. Then we have APR, annualized percentage rate, which means the total interest and charge expressed yearly, helping compare cards. And outstanding amount, total unpaid balance on the card. So take the case of Neha, right? To understand this, take the case of Neha. So Neha has a credit card. She misses a payment. The bank cannot immediately report her to civil. They must follow the process. Her card has 20% APR, right? And the bank shows how interest is calculated. Bank must show the calculation of interest rate, right? And that if she pay late, how interest is calculated, bank must show. Later she decide to cancel the card. She pay the remaining 10,000 rupees. The bank confirm closure and her card is deactivated. So what are the points which we have discussed in these two slides? First point is default reporting to CICs. Then interest rate, justifiable, ceiling prescribed, APR quoted with, APR should be quoted with calculation. Finance charge means method of calculation should be explained, examples should be provided. That is called finance charge calculation. Then transparency should be there, which means free card, variable rate, one charge communicated in advance, and changes communicated in advance. Then card cancellation, which means process promptly, confirm closure, and settle outside. Let's talk about the home loan. So friends, people borrow money for various needs, illness, education, buying a house or vehicle. Bank provide financial assistance, right, at reasonable cost and fair terms. So bank provide this financial assistance at reasonable cost as well as the fair term. Please remember it. Home loan are available to the salaried individual, professional, self-employed, businessman, resident Indian and NRI. So these are the entities, these are the people who get the home loan. Please remember it. Right. Home loan can be taken for buying a housing plot or construction of houses or repair and renovation of houses or sometimes for buying a house sites. These are the reasons for which home loan can be taken. Now the loan amount is decided based on the gross or monthly income, cost of the house and the borrower age. Right. These are the three factors that decide the loan amount. Right. Now the repayment period can go up to 30 years but cannot go beyond that. So the repayment period can maybe extended up to 30 years. Okay. And it cannot go beyond that point. So it cannot go beyond the borrower retirement age or 70 years of age. So remember, repayment period may extend up to 30 years and it cannot go beyond the borrower retirement age or 70 years of age. And most loans are repaid through EMI, that is called equated monthly installment. Okay, and this is planned according to the borrower expected income over the loan period. Then I told you about credit history. Credit history is a very important term. Bank check your credit score and past loan or payment record from CICs. Right. So bank check your credit score and past loan and repayment record from CICs to decide terms and interest rate. So what we have discussed here, we started with a retail loan. Let me just summarize. We started with a retail loan. Remember, retail loan is a loan given to individual and not company. That is called retail loan. Right. EMI, you know it very well. EMI stands for equated monthly installment, which means fixed monthly payment covering both principal and interest. Then credit score and history, which means that your record of paying loan and credit card on time. And CICs is the credit information company. So let me give you a simple example. Suppose take the case of Rohit. He want to buy a flat. He want to buy a flat for 50 lakh rupees. So he earned 1 lakh rupees per month. Okay. So the bank check his credit score, decide that he can borrow 40 lakh and give him 20-year home loan. His EMI is calculated based on his income and repayment period, ensuring that it is affordable. So home loan is a common retail loan for salaried people. Purpose is to purchase, construction, renovation, house site purchase. Repayment up to 30 years, not beyond retirement or 70 years. Mostly repaid via EMI. And credit score and history checked by bank through CIC for loan terms. Now want to understand how bank give home loan, how they charge interest, how they provide extra finance for repair and addition. So let's talk about it. So first of all, we are talking about the mortgage as security. You can see written here. mortgage as security, which means bank take a mortgage on their property purchased or constructed using during the usage using the loan. Friends, remember mortgage as a security. Bank take a mortgage on the property purchase or constructed using the loan. So this protect the bank in case the borrower fail to repay. Then we have the concept of co-borrower, right? Sometimes co-borrower or guarantor. So the spouse or the joint owner of the property can be added as a co-borrower or guarantor, sharing responsibility for repayment. Then we have the interest rate. So bank can charge. Remember, bank can charge fixed or floating interest rate according to their policy. And then we have financing land, which means that bank may provide loan for buying a plot only if the borrower plan to construct a house on it. Then we have purpose covered. What are the home loan? What are the purpose of home loan? So you can see for purchase of house and flat, for construction of house and flat, for repair, renovation, and alteration, second home or rental property. Right? These are various kinds of purposes which are covered. Now, what are the conditions for unauthorized construction? See, if the property is under unauthorized construction, bank may finance it only if a sanctioned plant is obtained. Right? So, in case of unauthorized construction, bank may process it if only sanctioned plant is obtained. Second thing is that a completion certificate is available, and third thing is that property is not used for commercial purpose. So this is the point. These are called condition for unauthorized transaction. Then we have customer suitability and transparency. So what does it mean? It means if the property is under unauthorized construction, I think we have discussed it. Bank must ensure that borrower understand risk and liability before taking a loan. Yes, borrower must be aware of the risk as well as the liability. That's called customer suitability and transparency. Interest over the loan tenure. The total interest depends on the loan amount, interest rate, tenure. Customer can choose a tenure suitably to their monthly budget. Then we have supplementary finance. Bank can give extra loan for alteration, addition, or repair to house already financed. Right. Then next point is individual who want to have a raise fund from another source. Supplementary finance means additional, alteration, addition, or repair. Individual who have raised fund from other sources against proper security and repair, addition to building, houses, flat, etc. This is called supplementary finance. So remember, we have talked about mortgage. What is the meaning of mortgage? Mortgage means bank holds the property as a security until the loan is fully repaid. Co-borrower and guarantor. It means someone who share legal responsibility for the loan. Co-borrower. Fixed interest rate. Fixed interest rate means interest rate remain the same throughout the loan. Floating interest rate means interest rate keep changing with the market price, or we call it with the market rate. Supplementary finance means extra fund provided for improvement or repair. So suppose Priya buys a flat with a home loan. Her husband is already added as a co-borrower. The bank charges a floating interest rate of 8% per year. Later they want to renovate the kitchen. The bank provides supplementary finance for renovation. So remember, home loan secured by mortgage, interest rate can be fixed or floating. Loan for purchase, construction, repair, second home, rental properties, slum scheme. Unauthorized construction requires sanction plan, completion certificate, not for commercial use. So friends, wondering that where bank cannot lend home loan and how they finance housing project, let's break it down step by step in easy to understand term. So basically, prohibited purpose for home loan. Bank cannot finance building meant for government or semi-government offices unless the project is refinanced by institution like NABARD. Right. So bank cannot finance the construction of building meant for government and semi-government offices. Okay, that is the point. Second point, bank cannot finance project by public sector entity that are not corporate body and they do not operate on commercial line. So bank cannot finance any project undertaken by any undertaken by public sector entities that are not corporate body or those that do not run on the commercial line. So these two things bank cannot do. First of all, financing for building any government in any government property, any government or semi-government office, unless the project is refinanced by NABARD. If it is refinanced by NABARD, then bank can do that. And please remember these two conditions, very important. Next point is lending to housing intermediary agency. So first of all, we have the financing of the land acquisition. This is the first point. It says that bank can finance land acquisition and development by public agency. They can finance the land acquisition, right, and development of the land by public agency, but not private builders, right, as a part of the complete project. As a part of the, you can see the point, the part of the complete project, right. Now land valuation should consider the following. What the land valuation should consider? Then land valuation should be based on the acquisition price plus development cost, and the current market price should be used as collateral. So land valuation should consider the acquisition price plus development cost, current market price for collateral. Now lending to housing finance institution. How do we lend to the housing finance institution? What we call it HFC. So bank can give term loan to HFI, right? HFI, not HFC, HFI. Bank can give the term loan to them. Okay. So bank can give term loan to HFI, right, based on the DER. What is DER? Debt equity ratio, based on the track record, right, and based on the recovery performance. And loan to NBFC must follow a specific bank finance provision, right. So a specific bank finance provision should be followed, right. And bank can provide term loan to a state housing board and public agency, but loan installment must be recovered promptly. What about the lending to the private builder? Yes, very important. So basically, that bank can lend to private builder on commercial term for a specific project with careful monitoring to prevent land speculation. Right. So bank can extend credit to the private builder. Please remember it. And loans should be based on the commercial judgment with proper scrutiny. It should be based on the commercial judgment. This should be appropriate security. This should be commercial judgment with appropriate security and no speculative pricing for beneficiary. And next point is term loan can also be granted against the loan sanctioned by housing intermediary agency. Suppose loan is sanctioned by housing intermediary agency, then in that case, term loan can be granted. And lending to housing intermediary agency must comply with the RBI norm on exposure to commercial real estate, right? Because bank has a limit on their exposure to their CRERH, commercial real estate. So what is the RBI norm? It must comply with that. Lending to housing intermediary. Please remember these key terms. So what we have discussed here, first of all, we started with the housing intermediary agency. So whenever you see this word housing intermediary agency, it means public agencies or institution involved in land or housing development. Then we talk about the commercial terms. Here you can see the term written commercial term. What is the meaning of commercial term? Yes, commercial terms means what? Loan provided with normal market-based interest rate and condition. Then we have speculative elements, right? What is the meaning of speculative elements? Speculative elements means extra cost added to property for profit. This is not allowed for loan meant for genuine beneficiary. That is called speculative cost. Then we have collateral. Collateral is the security placed to the bank in case the borrower failed to repay. Suppose borrower failed to repay, how much is the security placed to the bank? That's called collateral. And term loan means loan provided for a fixed period. That's called the term loan. So please remember this point, very important. So let me give you one example. Suppose there is a state housing board. They plan a new housing scheme. The bank finance land acquisition and infrastructure development, but monitor the project closely. If a private builder wants a loan for residential project, the bank evaluate the project, check security, ensure no speculation in pricing, and lend on commercial terms only. So what are the prohibited loan? Prohibited loan, just now I told you that semi-government office, government office, public sector entities not called corporate or commercial. So that is our loan to them is prohibited. Please remember it. So these are the very important points. Now the next point is public agency. So I told you now bank can finance land acquisition plus development. Collateral means acquisition cost plus development cost. Okay. So this is called public agencies. Then we talk about HFI and HNI, HFI and NBFC. So term loan based on debt equity, track record, recovery, they follow the RBI provision. Then we have the private builder. What is the meaning of this private builder? Private builder means that commercial loan for a specific project, monitored to prevent speculation. Term loan via housing intermediary agency. So that they require RBI authorization. They should comply with the interest and commercial real estate terms. So we have talked about what are the restrictions, what are not restrictions. Now, so prohibited purpose for home loan we have just discussed. How do the bank finance land acquisition, right? Then whether land valuation should be considered, acquisition price plus development cost, right? And lending to HFI. So bank can lend to HFI based on their debt equity ratio, track record, recovery performance, etc. Private builder bank can also lend to them, right, for a specific project. Please remember this data. Suppose there is a state housing board, right? A state housing board. They plan a new housing scheme. The bank finance the land acquisition, bank finance the infrastructure development, but monitor the project closely, right? So these are the points. Now let's look at this particular slide, which discusses the quantum of the loan. So if you talk about the quantum of the loan, this one is a very important topic from examination point of view. So based on LTV ratio, we decided. What is the meaning of LTV ratio? Loan to value ratio. LTV stands for loan to value ratio. So in this particular table, you can see how to decide the quantum of loan. Banks should adopt the following norm. First of all, if it is an individual housing loan, right, up to 30 lakh, then LTV ratio should be less than or equal to 80, right? Then in that case, risk weight is 35%. Then above 35 and one more is that more than 80 and less than 90, it is 50%. Please remember this chart, super important, from either any of the four subject, either in PPB or in INIFS, in RBWM, they will ask you. So up to 30 lakh, LTV ratio is, if loan to value ratio is less than 80%, then in that case, risk weight is how much? Risk weight is 35%. If it is between 80 to 90 lakh, risk weight is 50%. Now, if let's suppose the loan is above 30 lakh up to 75 lakh, then LTV ratio less than 80 and risk weight is 35. If it is above 75 lakh, LTV ratio less than 75, risk weight is 50. And CRERH accessible category, no LTV ratio, just risk weight 85%. Right? So remember, if LTV ratio is less than or equal to 80, risk weight is 35%. In all these cases, you can observe that. And if the LTV ratio is greater than 80, less than 90, risk weight is 50%. As you can see, you can just interpret this result from these two line. Let me show you. You can see it written here that if it is here, it is less than 80, 35. It is less than 80, 35. 80 to 90, 50. Right? So please remember it. Now friends, let's talk about the stamp duty registration and other documentation. Let's talk in detail about it. So friends, applying for home loan, do you know how bank calculate the loan? What documents are required? So LTV means loan to value ratio. Bank calculate LTV ratio based on the value of the house. Yes, they look at the value of the house property, then they decide the LTV ratio. They also look excluding any stamp duty, registration and other documentation charge. Now for economic weaker section, or we call it economically weaker section, or EWS. For EWS and the low income group, we call it LIG. For the EWS and low income group, please remember, where the house cost is less than or equal to 10 lakh. Okay, so bank can include these extra charges in the LTV calculation. Now one more point is that what are the required documentation for loan application? So agreement of sale and sale deed, you can see agreement of sale and sale deed, no income balance certificate, right? Then title search document for 30 years, then approved building plan, okay, patta, valuation report from the bank approved engineer, and financial statement, bank statement for the last 6-12 months, salary certificate for self and spouse, IT return for 3 year, KYC documents. So these are the documents which are necessary. And what about the processing fee and agreement? So you know it very well that bank usually charge around 1% of the loan amount as processing fee, right? So bank generally bank charge 1% of the loan amount. 1% of the loan amount is charged as a processing fee generally. After sanction, bank can take loan document and a guarantor agreement. They can take the loan document and the guarantor agreement if applicable. And the property must have insurance against the fire, earthquake and flood. property must have insurance policy against the risk of fire, earthquake and flood. And disbursal of the bank collect, what about EMI setup? So bank collect NACH authorization, right? And during the documentation to enable hassle-free EMI deduction automatically. What about the disbursal of the loan? So disbursal of the housing loan is linked to the stages of construction, right? It is linked to the stages of construction. Bank do not release full loan upfront for incomplete or under construction project, including greenfield housing project. So what is the, whenever you see this word LTV, what does it mean? It means percentage of loan amount to the property value. In the numerator, we write the percentage of loan amount. In the numerator, we write the loan amount. And in the denominator, what we write? In the denominator, we write the value, the property value. In the denominator, we write the value of the property. So loan amount divided by the value of the property. This is called LTV ratio. Then EC is nil. What is the meaning of EC? EC means encumbrance certificate. Patta means ownership proof of the land. NACH authorization means automatic payment system for EMI deduction. Suppose Sita want a home costing 50 lakh. The bank calculate the LTV excluding stamp duty and registration. Give her the 80% loan. She submits sale deal. Nil EC, bank statement, IT return, KYC, bank charges 1% processing fee, collect NACH mandate, and disburses money in stages as construction progress. So remember, these are the important rules. Now friends, that do you need money for marriage, education or medical expense? Bank provide personal loan also. So let's talk about the loan disbursement condition, personal loan, salary loan, etc. First of all, prior permission from borrower. This is the, just wait a minute. Prior permission from where? Prior permission from the government. You can see written here. From the government, local government, other statutory authority. So borrower must obtain prior permission from this entity for the project. Bank release money only after the clearance are obtained. So only after the clearance have been obtained, then only bank release money. What about personal loan? Bank may give loan without tangible security, relying on the personal security of the borrower. So without tangible security, banks sometimes give loan, relying on the personal security of the borrower. Common type of loan include, salary loan, loan to pensioner, loan to professional. These are the common type of loan, personal loan. Now, what about the salary loan? Salary loan are given to permanent employee with at least 3 years of service, with minimum 3 years of service, right? And so they should have minimum 3 years of service in the government, quasi-government organization, board, endowment, reputed company or corporate industrial establishment. These are the things for salary loan. And the purpose is to meet the expense like marriage, education, medical need, family function, household expense, etc. How do we calculate the loan amount? Yes. If you look at the calculation for the loan amount, how do we do it? Let me explain. So loan eligibility is based on gross or net salary. That is decided based on the gross or net salary. Bank ensure a minimum take home pay remains after EMI is deducted to make sure that borrower can manage repayment comfortably. So what we have discussed? We have discussed the personal security. Personal security, what does it mean? It means you on promise to repay the loan without collateral. Second point, salary loan. Salary loan means a loan given based on your steady salary. Take home pay means net salary after deduction like tax. Bank ensure that EMI don't reduce too much. So suppose Ravi, he work in a reputed company for 5 years. He need money for his sister wedding. The bank offer him a salary loan based on his income, ensuring that after paying EMI, his take home salary is enough for daily expense. So what we learned from this issue slide, bank must get government or local authority clearance before disbursal. Personal loan can be given without collateral. Common type include salary loan, personal loan, and loan to professional. Salary loan eligibility is that permanent employee more than equal to 3 years in a government, quasi-government or reputed private organization. Purpose is very simple: for marriage, for education, for medical, for family function, and household expense. These are the purpose. Now let's look at the next slide. Very, very important. So friends, want to know how bank decide your personal loan amount? So this section explains higher loan eligibility, employer undertaking, guarantees, documentation, interest rate and repayment option. So higher loan eligibility, higher amount eligibility, right? What does it mean? That bank may offer higher loan amount if the employer agree to deduct EMI from the salary and remit it directly to the bank, right? So to recover the EMI from the salary, see the key point. to recover the EMI from the salary and remit it to the bank, some bank consider a higher loan amount. If the employer give an undertaking, right? If the employer give an undertaking to recover the EMI from the salary, then it is allowed. And if the applicant has a salary account with the lending bank, suppose the loan applicant maintain a salary account with the lender, okay, they may also consider a higher loan amount. In that case also, higher loan amount may be considered. Sometimes, if there is no collateral, bank may ask for third party guarantee. Bank may ask for third party guarantee if collateral security is not available. And the employer can execute an undertaking. The employer can be asked to execute an undertaking to help the bank recover EMI from their salary. And proof of employment and salary certificate, these two are required to validate the income. Now, what about the loan documentation? Very, very important. Bank must obtain the DPN. This is called demand promissory note, salary loan agreement, right? And guarantee agreement. Okay, if applicable. Interest rate, loan without collateral usually have a higher interest rate since the risk to the bank is higher. Now, what about the repayment option? So, that bank accept ECS or debit mandate for automatic EMI reduction. Repayment period usually range from 36 to 60 months. Right, 36 to 60 months, and which means 3 year to 5 year, and bank charges a processing fee, typically a percentage of the loan amount for handling the loan application. What about the so what we have talked just now? Third party guarantee. I told you now, third party guarantee. Here you can see the word third party guarantee, which means that someone else promised to pay if you default. DPN means demand promissory note, which means legal document where borrower promised to repay the loan. Then we have salary loan agreement, ECS and debit mandate. What is the meaning of this ECS and debit mandate? It means automatic payment system that deduct EMI from salary or the account. That is called ECS. And then you have processing fee. Processing fee is the one-time fee charged by the bank for processing the loan. Right? That is called processing fee. Suppose Anil want a personal loan of 5 lakh. Right? His employer sign an undertaking to deduct EMI directly from his salary. Anil has a salary account with the bank, so they approve the loan at a slightly lower rate. So this is how it works, personal loan work. Now we have some kinds of consumer loan. What is the meaning of consumer loan? Let's understand. So friends, who can take consumer loan? Bank target individual with regular income, who include the salaried employee, right? We have a regular income, pensioner, professional, self-employed individual and others. Right? What is the purpose of consumer loan? The purpose of consumer loan, they help finance durable goods. Right, they help the finance the purchase of durable goods. Durable goods can include TV, AC, computer, vehicle. Now, what about the loan amount and margin? So the loan amount depends on the cost of the item and the margin bought by the borrower. Two things decide. First of all, cost of the item being purchased and the margin bought by the borrower. These two things decide the loan amount. Please remember, loan amount is a function of these two things, which is the cost of the item being purchased. What is the cost of that item? Second thing is the margin, which is bought by the borrower. Then only loan amount is decided. And usually bank require a 10 to 20% margin from the borrower. How much? 10 to 20% margin. Now security. The purchase item itself serves as a security. Right? Whatever the purchase item is, it itself serves as a security. And through a process that is called hypothecation. I think you are familiar with this word hypothecation. Right? So thus whatever item has been purchased, it itself remain as a security through the process called hypothecation. This means the bank has a legal claim over the item until the loan is fully repaid. So what are the documents required for obtaining a consumer loan? It includes the salary certificate. You can see salary certificate, IT return, quotation from the item and bank statement. So we started with hypothecation. What is the meaning of hypothecation? Hypothecation simply means bank can claim the purchase item if you don't repay the loan. Margin means the borrower own contribution toward the item cost. Borrower own contribution is called margin. Then we told you about DPN. DPN means demand promissory note, which is a legal document where you promise to repay the loan. Processing fee is the one-time fee for processing the loan. Suppose Reena want to buy a car costing 10 lakh rupees. She contribute 1.5 lakh as margin. Margin means the amount contributed by the borrower. The bank finance the remaining 8.5 lakh as consumer loan. The car itself is a hypothecated to the bank until she fully repay the loan over the 5 year. Bank charges a small processing fee during the documentation. So remember, these are the keywords. So, and grievance redressal machinery is there to address the customer complaint, right? Remember it. So friends, That is all we have to learn from this particular chapter point of view. I hope everything is crystal clear. You are already familiar with all these things.